Catherine. Welcome back to the podcast.
Oh, Molly, it's always such a pleasure to be here.
First podcast for you of 2025.
That's right. It's a brand new year.
Yeah.
Brand new season of podcasts in all its glory.
Sure is. It's only the middle of January, but it feels like this year has already been a lot.
It has. It has. You know, for those of you listening out there, we're in the midst of a cold blitz that, it was 7 degrees this morning.
We don't like it.
Don't.
We appreciate the winter around here.
Yes, we do.
We like seasonality, but we don't need sub-zero temperatures.
We sure don't.
No.
I wasn't able to walk into work today. That's bad.
That is bad. Well, we're going to talk about a topic that's not weather related, although the weather can impact this thing.
Sure does. Right. Yes, it sure
And
does.
that is financials. We have an upcoming financial fundamentals workshop in March. And as I was thinking about this workshop that you facilitate, it reminded me of a couple of questions that arose at the beginning of last year's workshop,
Right.
that people were, assumptions that they came in with or questions that they asked you. And I was like, ding, ding, ding. That's a question we hear all the time. We should be talking about it. It is. And it's also a topic that when I'm discussing, coaching with business owners who are interested in learning more about us, you always talk about financials. And this is something
Right.
that comes across conversations. And so what we want to talk about here is the difference between the accounting perspective of financials versus the strategic operational perspective that we coach to.
Right. And it's timely for a couple of reasons. Not only is the boot camp coming up, the workshop coming out, but also, so many business owners are right now in that they're preparing for tax season. Oftentimes they can get conflicting advice about what it is that they need to be doing, maybe with their money or in order to, better prepare for April 15th. And, our approach is more longer, it's a longer approach than that. It's not about preparing for one day. It's about every single day and how well your business is performing. So, I think when I think about your obligation to meet with and understand what you're talking about with your accountant is vital, but it is as opposite about as it can possibly be from what we coach to. And it's a good conversation.
Yeah, which is why it's shocking that it's taken until now for us
Right.
to really talk about
Right.
this as a full-on conversation. When you work with new clients, how often are you having to explain this difference or kind of coach them through the two different perspectives?
Almost always with new clients.
Okay.
And I wouldn't even limit it to new clients because, I was just on the phone recently with a client that I've worked with for a number of years. And, they are asking pretty directly, why do you tell us to do this when my accountant is telling me to do this? And, that's a good question. We need to be prepared for that as an explanation. But also, like I said, that accountant is looking out for your best interests and wanting to mitigate any unnecessary tax burden that you might have. And so they're making decisions or helping you to make decisions that are going to help you with that. But really what we do is we want to understand the machine itself and we want to understand how profitable the machine is. And so it's almost like they're saying, reduce profit, reduce profit, reduce profit. And we're saying, build profit, build profit, build profit. And, so it's a good question and it requires us to talk about it a lot.
Yeah, so obviously there are important components to each. So it is, it's not like one is not bad. They're just different perspectives.
They're just different perspectives.
What are some advantages of looking at it from an accounting perspective, or what kind of business decisions might you be making based upon that perspective?
So, I was in preparing for the conversation, I was talking about this with Colin, and, Colin has a really great analogy that I'm going to reference here because
You could have just made it your own.
I could have.
But we'll give credit to Colin.
We'll give credit to Colin.
Yeah.
But, he was talking about how when an accountant is looking at a series of financial reporting, they're looking at the destination. Where have you arrived? They're not looking at the tracks. They're not looking at the machinery itself. They're not looking at how good the machinery operates. They're not looking at if the machine is in need of repair. They're just looking at the destination. And that is a very important part of your financial analysis, that destination. It helps you to identify where your cash has gone. It helps to identify maybe your billing practices with customers. It might help to identify some growth decision that might help to further some tax benefits from you for you. For example, if you're expecting to grow in the next year and you know that part of that growth will need equipment acquisition, your accountant might say, let's go ahead and buy that in this year because that's going to help you on a tax level. The flip side of that, though, of course, is how we look at it, which is that we definitely want to be making sure that we understand your vision and we understand where you want to go. And if equipment acquisition is a part of that, then we want to be planning for it.
Yep.
But we're very, very interested in that machine and how well it's operating and how well you as a business owner and your management team are looking at that piece of machinery and regularly reviewing it. Just like you would take your car in for an inspection, how often are you looking at it to say, this is working, this isn't working, this is in need of repair, this is in need of a little grease,
And we do those things so that we can put off need to have to purchase something brand new.
Right.
Every few years.
How
long can we healthfully maintain this piece of equipment?
Unless squirrels get involved.
Oh yeah. Fair warning. If you want a story about a car and squirrels, ask Catherine.
Just ask me.
Yeah. Not good.
No.
Expensive.
Very, very.
More of a headache, though, than even expensive.
Yeah.
Okay, so we obviously know that there are advantages to looking at it from an accounting perspective, and that's why, accountants have a valid part in this.
Right.
But the strategic, the operational view of the financials, how does that shift things?
Well, so I think that there's a couple of examples that I would call into play here. So, I talked about the machine, right, and how we are looking at the machine. But if I also think about growth, there are times when an accountant might be saying to you, you're going to have a big tax bill. What is it that you can buy in the next 6 weeks? Or what is it that we can, where can you dump some money?
Yeah.
And we might say, hey, listen, pay the tax bill. I understand everyone's desire to sort of minimize that as much as possible. But in this case, we might say, pay that tax bill and hold on to that cash. Because if you are dumping it into a piece of machinery that maybe you're just doing it because you want the depreciation on it, or maybe you're just doing it because you don't want to pay taxes, but now you've taken away cash and maybe your ramp up for the spring season is going to be that much tougher. And you might need to dip into your line of credit in order to pay for materials, or maybe you need to put stuff on credit card and pay that interest rate. So now you've made a short-sighted decision based off of one piece of advice that actually might end up costing you in other ways that you really haven't considered. Like, have we really talked about interest rates and credit cards these days?
Yeah.
And if you're buying $200,000 worth of plant material for your operation and you're putting it on a credit card, that can be a lot that you might not have had to worry about if you're...
Well, it's such a good point. I mean, we talk so much and we hear so much about small businesses struggling with cash flow.
Right.
And to also grow to scale. What do you need? You need cash. You need access to capital.
You do.
And so we have to think about cash from an operational perspective here and not just tax savings.
Exactly. And so that's where, you as a business owner, you want to listen to the counsel of these experts that you're working with. So you've got your accountants that's saying, unload it. And maybe you've got a business coach that's saying, hoard it. and somewhere in between is what's right for you.
Yeah.
And it could be that you say, all right, well, I don't need to unload all of it on a piece of equipment, but I do know that I've been looking at this particular truck, or I've been looking at this particular piece of equipment, and I think it's going to generate revenue for me in 2025. And so therefore, I'm going to go ahead and I'm going to get it now. And that's really what you want to do, is you want to take the information that you've been given and you want to make the best decision for you and your business. And not just reflexively say, oh my gosh, my accountant says I got to spend all this money. I'm going to go ahead and buy, a $500,000 piece of.
So this conversation probably comes up starting October, November, December. Yeah. Are you hearing those conversations with your clients as we get towards the end of year?
Yeah. And I'm wanting to make sure that starting in September, I am advocating for any of the clients that I'm working with to start their tax conversation with their accountant, because that way I can help by understanding understanding what the tax expert is recommending, and we can help to make a good and solid decision.
Work together,
Work together,
not against.
That's right. And to be clear, your CPA, your accountant, they all have very valuable roles. I am not a tax expert.
Yeah.
I don't want to be giving tax advice, but I can help you as a coach to sort of break down what it is that's going to be best for your business and operate on a sounding board level to say, this makes sense to me. This maybe doesn't make sense to me. Go back and ask this question, which, that's also something just in general in terms of tax planning. Like, don't be afraid to ask questions that you think that you should know the answer to.
Yeah.
I always feel like, I remember, stupid question is the unasked question. And so when you're going to your accountant, just go in. Hey, listen, I'm not the tax expert. I'm going to ask you a lot of stupid questions. I can guarantee you they would be so thrilled to hear that.
Yeah,
so thrilled.
They want conversation.
They do. They really do.
It's part of it, educating it. The more that you know as a business owner, the easier that relationship between the two of you also comes year after year. And you understand, you're talking the same language, you understand the strategy around it. How does accrual versus cash accounting also play into this conversation?
Right. And, most business owners that we work with are filing their taxes on a cash basis because of their tax status. And we coach to accrual accounting. And so just a quick sort of primer. Cash accounting is when you are doing your accounting or your reporting when you are receiving money in for jobs that you have performed. So what that means is that you could be doing a job in November, but maybe somebody went away for the holidays and they didn't write you a check. And so now in January, which is an entirely different year,
Yep.
you're recognizing revenue. Accrual accounting is when you recognize revenue as it's produced or as it's invoiced, billed to the customer, and as you pay those bills as well. You're getting a clearer picture of how well that machinery is performing because you generate a job today, you invoice it today, you pay your team today, you pay your vendor bills today. What's remaining is your gross profit. Under cash accounting, that's not the case because, like I said, it could be weeks or months before you're recognizing revenue, and you really don't ever then get a clear picture of how well you're operating.
Then that to me is such a good, we talk about your numbers are the story of your business.
Right.
And so the accrual way of looking at it is really the story. It's the page by page play of each month.
Absolutely.
And cash becomes really hard to connect what happened to money received.
It is very difficult. And, I think we tend to think of the cash as being, well, I've got $100,000 in the bank, I'm doing okay. Mm-hmm. Yes, but that's a balance sheet discussion. A profit and loss discussion isn't about how much money you have in the bank. It's how well you're working and operating and how well your team is producing, how well your sales team is selling. Are you making the right decisions in your overhead in order to make the business successful? Those are all a part of an accrual conversation. Cash in the bank, that's your balance sheet. Do you have the right amount of money in the bank? Do you have the right days cash on hand? Are your current ratios looking okay? Is your debt to equity solid? All a balance sheet conversation. So don't conflate the two.
I think the two of them get conflicted a lot.
Oh, they do.
Are
they
confused
really do.
by a lot.
They are.
Because I come across that quite often as well, talking with, smaller business owners or folks who just got started, and they, I ask, what's revenue look like, or how's the health of the business? I've got money in the bank. I've got cash in the bank, which, it's good to have cash in the bank, but that does not give us any indication of what's really happening.
It really doesn't.
In the day-to-day. And our goal, we need to understand what's happening in the day-to-day to be able to make the right decisions about moving the ball forward.
Exactly. And you could have cash in the bank, but because of the growth of your business, what used to be an okay number 6 months ago, 2 years ago, is no longer a good number. And so you need to reframe that as well. Like, your expectations about what financial health looks like is going to grow and should be growing as fast as your business is growing. I used to work with a business owner who was regularly growing and who used to think about a $50,000 nut as being okay, but when we looked at their days cash on hand, it was like 3. That's not really enough.
Yeah. Well, and we talked about this before, but what is our recommended days cash on hand?
We talk about 30 days cash on hand and 2 months of reserves, and the reserve number is driven by your average overhead obligation.
Okay.
So 60 days cash on hand plus 2 months of reserves. And, let's be clear about that. Nobody ever thought that the pandemic would occur, but it was those businesses that had the 30 days cash on hand that were able to sort of make the decision about what was going to happen before, sort of workarounds came into play. But there were a lot of municipalities and governments that shut down, and without those days cash on hand, they wouldn't have survived. That's a long and impassioned plea
but
I
as much as we don't want real life examples to like come into play to like the hypotheticals that we talk about, the pandemic is a really great example of how important having the days cash on hand and the reserves were.
Oh yeah, absolutely. And those businesses that came out of it, I mean, there were a lot of government programs too that helped businesses during that whole time period. But the ones that survived were the ones that were prepared.
And we want all of our clients and all of our listeners who are working in small business to be surviving any non-controllable thing that comes our way.
Exactly.
You said something to me, you kind of hit on it, a little bit earlier, how we look at things and the operational view of the numbers and where things fall on a P&L and how, certain revenue streams that might come in that maybe the management team has no control of. And so where does that revenue fall? Whether it's a subscription to something or whatever it may be, just a recurring revenue that has nothing to do with the management team's control of operations.
Right. My best example of that is when business owners own real estate and then maybe rent an office in that facility to somebody else and are collecting a check on that rent. That's something that we would put below the operating profit line and before net profit, because as you were mentioning, the management team doesn't have any control over that. It is money that needs to be recognized as coming into the business, presuming that the property is owned by the business. So it's coming into the business, but they have no control over it. It's not a sales conversation. It's not a revenue stream. So we put it below operating profit and above net. That operating profit is the conversation that I'm usually having with my management team. So I coach a number of businesses where the entire management team is on the call and we're reviewing our revenue, our expenses related to that revenue. So cost of goods and our gross profit, and then we're looking at overhead. I, as a member of the management team, can have influence over marketing spend, right?
Yes.
You and I talk about marketing spend. It's ultimately your decision, but I can weigh in there. But there are things that I can't weigh in on.
It's my decision until I have to defend it to Brian.
Right. We had to defend our dissertations.
We joke about that.
We do.
We all give our budgets in for the year, and then Brian reviews, and we all have to line by line.
That's right. Right.
Prove what this is, why it's important, which is it's a good practice for us to be doing that.
Yes.
But it's our decision until we have to defend it.
Until it's not. But no, and on that note, but just in general, if this is not a common practice in your business, I would absolutely advocate for it, that those people who have some departmental responsibility are actually sitting down and reviewing what was spent in that department and then having an opinion about what needs to be spent in the year upcoming. That could be, we need to spend more money on AI. It could be, I think that we are spending too much different technology. It could be a whole host of things in terms of like drilling down some responsibility, but also now you've got somebody else's opinion out there. You've got somebody else's perspective and somebody else who might be saying, hey, you know what? There's a really great technology out there that's going to help us do something. This is the cost. So you're not having to do it all yourself as a business owner.
Yeah. Share the wealth of budget creation.
Yeah.
A lot of business owners think that creating the budget has to fall directly on their shoulders. And we see that not to be the case when discussed and communicated and delegated effectively. You let your team work on pieces of the puzzle, then the puzzle comes together.
Exactly.
It's a whole lot more effective that way.
Absolutely. So if we bring it all the way back, right now think about that in terms of your financial reporting. You now have a group of people who are weighing in on your financial reporting versus a scenario where you might have one CPA or maybe there's a CPA with some administrative support within their office looking at your numbers. It's a different dynamic altogether, right? You've got your team that knows how you operate, what the vision is. They understand your values. Each of them is bringing something to the table for that conversation. And then there's your CPA, and they're looking to protect you from a tax basis. And like I said before, totally respect that, but it's just a different experience.
Yeah.
It really is.
Well, it's worthy of this conversation because, as we said, both are important and both majorly impact how you approach your planning and your purchasing growth strategies. Both should be considered and part of your team as you grow. Are there any, just to kind of wrap us up here, are there any simple tools that owners can implement as they start thinking about the way that we look at numbers? Whether it's, an organized chart of accounts or it's maybe shifting to that accrual basis.
Yep.
Working with the bookkeeper. I mean, just like simple things to get started, because the bigger you get, it's going to be complex.
Yeah. So first thing would be, we typically recommend that you work with a bookkeeper, and that bookkeeper is not affiliated with your CPA. The reason being that if the bookkeeper works for your CPA, their checks are getting written by the CPA, their first and primary focus is going to be responding to the CPA. So find a bookkeeper that's not affiliated with your CPA. If you're already set up that way and you like them, don't worry about it. It's not a earth-shattering or life-altering decision. It's just a recommendation. If the bookkeeper works for you, they're going to do what you wanted them to do. I would absolutely recommend a very clear chart of accounts. I have worked with so many businesses who have people working in their books who are regularly adding things to the chart of accounts just willy-nilly, because then
danger zone,
right?
Yeah.
So now you end up with a P&L that's 50 or 75 lines long, and each item has maybe 1 or 2 entries over the course of the year. You are never going to look at your P&L if it's that clustered, right? You're just not.
That's a great point.
Create a chart of accounts. We have a chart of accounts that we recommend our clients use. There's some broader buckets like marketing. Under marketing, we would put uniform acquisition, and we would put charitable donations, and we would put advertising, and we would put SEO, right?
Yes, for sure.
Right. You can, but then it all rolls up into that. And so you as a business owner can look at that P&L without all of the unnecessary detail. Because that's the next thing I'm going to say is make sure you're looking at your P&L every single month.
Say that for the folks in the back.
In the back, every single month. Look at it every month. Numbers are facts. They are not feelings. They are not out to get you. Not looking at your number.
That's a fantastic line. Numbers are a fact. They're not feelings.
They're not out to get you.
Yeah.
Because, that's, I think what happens is people, it's January, I know that the cash flow is tight. So, I don't really need to look at my P&L right now. I know that we don't have a lot of business. No, you need to know. You need to know, did you sign up for a home show that's going to be happening in April? And so your bookkeeper paid the bill because you agreed to the contract.
Yeah.
And now you are $6,000 less than you think you are, which you wouldn't know if you weren't looking at your numbers. So look at your P&L every single month. And I want to make sure that I draw the correlation here that looking at your P&L is not the same as reviewing your job costing, because I think that often happens too. We get people who say, I've got plenty of money in the bank. I look at my job costing tells me that I'm okay. But once they look at their P&L, they're realizing that there's a lot of bleeding that's occurring because the job costing is capturing what's happening on the job, but they're not capturing how often we're going to the paint store, or maybe, the time that's spent in meetings, which we would advocate for, but you need to understand the cost of it. So when you look at your P&L on a monthly basis, those are all of the things that you're going to be able to see that you maybe aren't going to be seeing if you're just looking at your balance in your bank and you're just looking at your job costing. So bookkeeper, I would advocate for them not to be an employee of the CPA. And I would say, look at your reports, your financial reports every single month.
And chart of accounts.
And a chart of accounts that's simple in execution, but can have the appropriate sub-accounts so that you can track the things you need to track.
If you are a long-standing listener of Out of the Hourglass and you need some assistance with what a recommended chart of accounts looks like, reach out to me. You know my email if you've been listening for a while.
Right.
And I would be happy to share a version with you. Just a little plug.
Just a plug.
Yeah. This is great. I think this is exactly what I wanted to hit. It just kind of brings us into the world of why and how, and unpeels the onion a little bit of this kind of financial cloud sometimes that feels like it has feelings over us. us.
It does. It does. It feels, yes.
If you are a Summit member and this topic was stimulating to you and you want to learn more, like we said at the beginning, we have an upcoming Financial Fundamentals workshop, March 12th, 19th, and 26th. The sign up is available in your Summit Weekly. We can get you registered for that. Catherine is, of course, facilitating it. And I said this to you before, you do such a great job with this because you equate words to financials or words to numbers in such a wonderfully explainable way.
Well, thank you. I appreciate that. They tell a story. Once Brian said it to me like that, I was like, oh, yes, it is. It's a story. I can relate to this completely.
Every company's Summit Financial Workbook is a new book that she's just ready to read.
That's exactly right. Brand new chapters.
Yeah. Every month's a new chapter. New characters come into play.
Yep, absolutely.
Unexpected things.
Plot lines.
Yeah.
Mysteries. You got it.
Yeah. It's really exciting.
It is exciting.
Catherine, this was great. Any final words you want to leave us with?
No. I think I always appreciate being on the podcast and sharing this kind of wisdom with everybody. So thanks for having me on.
All right. Well, until next time.
Great.